Welcome to this new episode of the Transformation Compass, the talk brought to you by the Doctorate of Business Administration program at ISC Paris, and where we decode with our guests change and impact in our complex world. My guest today brings with him years of experience and expertise at the intersection of two fields. The first field is that of finance. A business school graduate, he has covered almost the full spectrum of emerging markets finance. M&As, private equity, project finance, venture capital, and DFI at both sides of the table. The second field is that of doing business in Africa, a continent where he oversees the financing of major projects, and one that he has studied by challenging himself into going back to school for a Master of Science in African Studies at Oxford University, as well as by launching his own entrepreneurial venture with a social focus. Geoffrey Coombs, welcome to the Transformation Compass. We're very glad to have you with us.
Thank you for having me.
Given your fields of expertise, our episode today is mostly about financing and facilitating transformation in Africa. And maybe let's start there. Africa. Consultants and business magazines always portray Africa as the next big business frontier. Academics and politicians like to focus on the specific challenges and risks of the continent, for instance, environmental challenges, demographic challenges, transformation. From your experience, though, navigating the continent over the last 15 years, is it fair to talk in singular about Africa and African risk, or is this a sort of a misleading oversimplification?
Well, I think it is a misleading oversimplification. But before we even get into that, if we're going to talk about risk, then let's also talk about opportunity. I think that there's certainly two sides of the coin, and we would hope that the opportunity side of the coin is a more important one. But I think it is an oversimplification, and I think that you knew that when you were asking the question. It's an opportunity to start talking about the topic, but we have a lot of stereotypes about Africa being a certain way, and I think that the answer to that question has actually become almost a stereotype in itself, albeit an important stereotypical response, which is to say that no, we shouldn't oversimplify, we shouldn't generalize. Africa is many different countries, 54 different countries. It's a whole plethora of different economic and political and environmental contexts in which we operate. I think before going further than that, I'd like to explore the question a bit further. I'm talking here about a collection of contexts, Africa, the continent. I'm not African, and I've not lived in Africa, but I have done a lot of work in a lot of different environments there. And I think maybe the first thing I would say about why this oversimplification is dangerous is because we can also look at it from an opportunity perspective. If we do that, then I think one interesting piece of work that was done recently by some contacts of mine in the infrastructure sector said something which is quite interesting with what we're talking about here. So first thing they looked at was debt default. So debt defaults on infrastructure projects across the region. And what it found was that actually debt default levels in these projects in Africa as a continental space were lower than one would see in Europe or in North America. While that being the case, on the other hand, levels of reward or levels of return or interest rates on that debt were higher. So you're getting higher returns, but the risk, at least on a statistical basis, is lower. So the risk-adjusted interest in investing in this space is actually disproportionately favourable towards Africa versus other markets. So I think that we need to bear in mind how some of these preconceptions might turn us off to opportunity. And then the second thing, coming back to your question more directly, is that we shouldn't oversimplify. We need to look at the complexity and the varies from geography to geography, from market to market, and from economy to economy. I think it's also sort of an opportunity in this question to look at some of the common tropes in relation to Africa. Ideas that Africa is poor, yes, there are large vulnerable populations, but there are also pockets of greater wealth, and there are people and populations that can afford and want services and goods which are of a higher order of magnitude within the chain. I think in addition to that, we would talk about maybe political instability, but that again is something which is not sweepingly true. There are places which have been stable democracies for very long periods of time and seen transitions of power, and so political risk isn't something that we can view as something homogenous across the continent either. So I could go on and shatter many other myths about the continent, at least based upon my experience working there, which of course should be complemented by local voices. But I think that's enough to illustrate, and I think maybe two things I'd want to say is that, or maybe even one, is that you need to do your homework if you want to operate in this region, and if you don't, then you'll miss opportunities as an investor, and the competition will eat you for breakfast.
You need to do your homework. That's something that sounds very like a very sound advice. I would say definitely. One might think that this is something you should do in every market, not just in Africa. Is it more complex in Africa? For example, is the data more scarce, more complex to analyze, to get? I'm guessing you do a lot of due diligence, for example. You work a lot on these issues. How easy is it to do one's homework when it comes to Africa? Yeah.
So I think the first thing that we can talk about easily is data, paucity of data, paucity of quality data. There are statistics that are out there, for example, but there's quite a lot of academic work which points to reasons why national statistics in many contexts is not as reliable, because it itself relies on fewer data points. So data is difficult. I think that from a commercial perspective, there are many sectors that have been maybe less studied. And what that can lead into, and I think this is maybe something we might go on into later in this discussion. So studying is data, but studying is also qualitative things. One thing which I think is very interesting in many areas of business is behaviours of different kinds of stakeholders. And there are lots of things, I think, when you're operating in a context which is less studied, whether or not you're somebody who's internal to the dynamics that are taking place, or somebody who's looking at it from outside, if there's been less study, if there's been less reflection on certain things, there's probably going to be less understanding. And when there's less understanding, there's more scope for, I'm not sure if they're black swans or if they're black signets, sort of along the way, which can mean that the best laid plans can lead to unexpected outcomes.
You mentioned now, but earlier as well in the conversation, you mentioned the fact of being like an insider versus an outsider. And yourself, you're someone who's not native to an African country, and you even said that you have not lived constantly in Africa, but you've been working there for many years, spent many years on the ground, immersing yourself in various markets. My question is, can you speak to us on, if I may call it, the initial learning curve for someone who's an outsider? How did that go? What specific challenges did you encounter to get to a point where you are able to have this understanding, maybe not exactly like an insider, but no longer as a full outsider?
I don't know if I'm going to give you some sort of vague spiritual answers to this question, but I think it's more about the attitude. And that's not something which is Africa specific as an outsider. I think it probably applies to all kinds of cross-border business, particularly though in context where there is less formally available information. So the first thing which I hope has worked for me has been a degree of openness to new experience. I think in addition to that, knowing where my strengths are, but also where my weaknesses are in terms of knowledge, or weaknesses in terms of my ability to understand. And in those environments, try to really listen and call upon external advice when I when I can see that there's something that I'm not getting. Sometimes, of course, there will be the unknown thing that you didn't know that you should know, but that's perhaps some sort of way of trying to capture that and then capitalize on experience as you progress through time.
When I asked you my first question about risk, you pointed out also opportunity and the importance of opportunities across Africa, the question of default risk versus return. I find this a very interesting insight. But if we go back to the risks, can you help us maybe unpack some of the granular risks at the level maybe of certain countries, sectors?
Yes, I can. I think, but I say that and I hesitate slightly because I think that, as in any context, the risks are numerous, and I think that the profile of those risks varies enormously from country to country, sector to sector, project to project. So what we can try to do, generally speaking, is look at maybe a hierarchy of granularity, if you will. So you have the macro level risks, and here we're interested in geopolitical things, we're interested in economic things happening at a level which is perhaps international in scope. Maybe for that first layer, to give an example of something that we look at, which is relevant in the context of doing deals. So I've looked at a number of things in Ethiopia as an example over the last decade or so. And in Ethiopia, one thing which has been a persistent issue for that economy has been the availability of dollars. So availability of dollars, and then a second thing which is a related issue for perhaps an international investor who wants to repatriate profits is exchange control. So you've got kind of two related issues. Dollars important because if you have any business counterparty that needs to be paid in dollars, then you need to get access to that money in order to do so. And given that dollars are not so widely available, there's a queue, there are different ways to move up that queue and to get access to dollar-based funding when you require it. But that's something that needs to be thought about carefully. You need to think through when you're going to need what and how you're going to make sure that you're going to be able to get to it when the time comes. And then the second thing is, if you're an international investor looking for returns, how do you get that money out subsequently? So that's macro level example of a risk. Then I think that the next level is going to be sector level within a country. So that might be things like regulatory risk, competition, maybe the structure of the supply chain. I think there are a number of reasons why we could think of that as important within the broader global geopolitical context right now. And then the last level, perhaps not the last level, but the third level in my chain is the country or project level risk. So at that level, we're thinking sometimes about things which might even appear to be quite micro. Management, dynamics between management, what they're able to do, what they're not able to do, how straightforward would it be to make changes. I think maybe in addition to that, maybe the location in which you're working. If it's a specific infrastructure project, exactly where is it? Does that make it more prone to certain kinds of security risks or natural disaster related risks, things like that. So if that's helpful, what you have is a kind of matrix or spectrum through which you would look at these different layers of risks that you would look at, which of course are also interrelated, but that's maybe a way to do it. I think that the difficulty that comes again, and again, I don't think it's specific to the African continent, but it is perhaps more specific to less studied environments with less access to data, is that you need to try to make judgment calls in a context where there's higher uncertainty.
So in addition to your experience in funding projects in Africa, you also have a founder's experience as an entrepreneur who successfully built your own venture in Africa. I'm very interested in hearing more about this.
Okay, yeah. The first thing that we'll say here, I think, is you're very generous to describe it in the terms that you have done. I think that it's perhaps more interesting and a little more straightforward to say that I don't think it was a success. It was a failure. It didn't work in the end. And maybe there are some interesting learnings that we can get into in relation to that. But would you like the story?
Maybe, yeah,
the story of Genesis?
Story, if you can, exactly. If you could walk our listeners
Okay.
a little bit through your journey as an entrepreneur in Africa.
Okay, so we'll do the origin story, and we'll do the.
Let's do that.
We'll do Armageddon after. So. I suppose, I mean, I became inspired to be an entrepreneur while working for the French DFI Proparco, so the French Development Bank for all intents and purposes. And the great thing about working in that kind of environment is that there's tremendous deal flow. You see all kinds of different sorts of investment opportunities in a range of countries, in a range of sectors, different kinds of deal structures. So you get all kinds of exposure, and I was also exposed to that at a time when there was growing interest in the continent. I think there were narratives around these sort of widely known narratives. There's one which was Africa rising, another one which was the emerging middle class consumer. There was also a lot of buzz around the African startup scene at the time, and so that sort of planted a seed in me, a kind of idea that maybe I would like to try to do something which had an impact focus, but was a project with a commercial objective. So there was that, and I was interested also in supply chains, particularly fresh produce supply chains. I'd noticed that there were what were at least for me perceived inefficiencies, and I'll maybe come to that a bit later on as well. And so that interested me. And then I read an article which was more of an anecdotal piece than it wasn't a McKinsey report. It was a journalist who was, I think, on a beach in Ghana. And he bought fish from a fisherman, or he was telling the story of buying fish from a fisherman. And there's a price that you pay for that. And he explained that as that fish makes its way through the downstream value chain to the end consumer, it could increase by price 3 or 4 times. So I thought, all right, that's kind of interesting. Why is that? That sounds in some way sort of, I don't know, dissonant or counterintuitive with what maybe makes business sense. So started trying to explore that a little bit more. Came to understand that the artisanal fishing, so it's not the industrial guys, the guys who go out in the trawlers, but the
small fishermen.
The small fishing boats, yes, so
yeah.
the canoes. So those boats will go out and they'll come back. And to give you an idea of the order of magnitude of relevance of this for the country, we're not talking about some sort of marginal activity. We're talking about maybe 3 million people out of a population of around 30. I hope my numbers are right. But anyway, the important point is about 10%.
10% of the population is in that
10%
business.
of the population is directly or indirectly somehow affected by this activity, which is an activity which is facing all kinds of pressures and challenges, and we'll get to that. But what happens is the fish comes off the boats, and then in many cases, plenty of studies on this actually, the fish will change hands 3 or 4 times before it gets to the person who eats it or fries it up and then eats it. And what's happening, of course, is that margin's being added a little bit everywhere along the way, and you have an issue with traceability because that fish is going goodness knows where before it gets to the final plate. So traceability, quality issues, increases in price, which are at least not directly economically productive. Of course, it's important to take care of those people who are in the middle of the value chain. They need to be doing things to earn their own income.
There were problems to be solved.
Problems to be solved.
To
this is
talk
the
in
problem.
Entrepreneurial lingo.
This is the problem. And so then there was the solution, so to speak, which was to try to connect the beginning of the chain directly with the end of the chain, address some of these issues of traceability, and hopefully share the economic benefit of reducing the inefficiency in the chain, both in terms of lower end prices for the end consumer and a higher initial payment for the fisherman at the beginning of the chain. So that was the idea, and maybe just to sort of come to the final point on that, there are and there were numerous models in sub-Saharan Africa generally, that were looking at the producer, be it a farmer or a fisherman, and using various components of the, if we can call it the technological revolution that we've seen, I don't know, since the arrival of the iPhone, for example, using that and other innovations in order to bring produce closer to the consumer and reduce waste and problems of traceability, and also help with prices in different verticals. Bananas is the most famous one, but there we go. So that was the idea. That was the origin story.
And the Armageddon story?
Oh, you want to? This question wasn't in the notes.
You said you wanted to get there.
So I think, no, we can talk about that and what was difficult. And I think maybe that's interesting to talk about some of the learnings maybe for other entrepreneurs I might see.
I mean, like you very candidly labeled it as a failure. And what I want to try maybe to understand for our listeners is maybe what specific street smarts did you get? What learning points did you get out of this experience as a founder? And how do they help you today better understand resilience of entrepreneurial projects in Africa?
Okay. So maybe we can think about two things. I think one of them is execution and execution timelines. And another one maybe comes back to understanding behavioral things in relation to stakeholders. There are probably some other ones, but let's start with those two. So the first one was execution, I think. So one thing that I think that we maybe underestimated when we were working on our project was the length of time that is required for new ideas to take root, to iron out difficulties, and potentially look at ways of nudging towards behavioural change. And the reality is that we spoke about these black signets before, these sort of unexpected things which don't necessarily blow the whole business model out of the water, but require you to reflect very fundamentally. To be derailed, yes. So those will come up. I have a friend right now who's starting a new business it's in food transformation in Central Africa, and looking how to help relatively geographically disperse farmers to transform on site and then feed into a downward value chain, a downstream value chain to reach the end consumer. And I think one of the really interesting things that he's done, if I remember correctly from his pitch deck now, is he's given himself a whole year to think about how this interesting new food processing technology that he's developed, how that will plug into downstream distribution chain, and then the other bit, which can be pretty tricky, at least in my experience, which is the final route to market. So you get your produce more or less where it needs to be, but then how are you commercializing it and who are you pushing it out to? That can be quite hard to manage, can be quite hard to figure out how to incentivize your sales teams, which are the real core channels that you should be focusing on. And he's given himself, as I said, a good year to do that. I think that's a really smart thing for him to be doing.
So basically trying to understand how your project and solution fit within a bigger local ecosystem.
Yes, and giving yourself time to adapt the model and understanding that you're probably likely to encounter greater uncertainty than you would do in, for example, certain European markets. So I think that's one thing, execution and time frames for that, giving yourself enough time, not promising too much too early to external counterparties that may be kind of waiting over your shoulder for brilliance to be delivered. That's one thing. And then the other thing was stakeholders and kind of behavior. So I think let's talk about my specific case. So, and maybe there's certainly a cross-border thing here, and kind of looking in and trying to propose solutions maybe in context that one doesn't fully understand. A at least personally, I was confronted with behaviour that at first sight, for me, I thought, well, this is illogical. Why are things working like this? It must simply be because, I don't know, maybe no one's come in with enough capital, or maybe no one's come along with this new technology yet, which will allow things to work in a slightly different way. Examples being a fisherman on the beach sells produce to one potential buyer at a lower price than he could realistically have achieved if he'd sold the whole lot to this person over here with lots of cash in his pockets. Why would he do that? Doesn't make sense. Surely if you come along with one person who can buy everything off the whole beach in cash today, that'll be so attractive, it will address some of these kind of sources of illogical behaviour. So if you follow me, there was a deliberate decision to sell to somebody who was offering a suboptimal price. And that seems illogical at first sight, but when you consider the fact, as I suppose we did subsequently, that you're operating in very, very high poverty environments, fishing communities among the poorest in Ghana, so operating very high poverty environments, and there is, my understanding again, which I'd be happy to be disabused of, but there is a collective sense of responsibility for one another. If that person who took a little bit of produce isn't able to sell, they don't have economic activity, so that person's going to be in a very difficult spot. The person selling recognises that they need to be supportive of their linkages around them. So if you come in with a solution which allows them to optimise their earnings by 5, 10, 15%, yes, it will be interesting to them, but only to a certain extent, and always within the context of a social fabric which is equally, if not more important to them. So where have I gone with this little narrative about fishermen trading off who they sell to? The point, I suppose, is that you need to take the time to be sure that you really understand what's going on.
The culture, and like
Yeah.
not judge it out of your own prism of maybe
Absolutely.
a Western way of looking at rational decision making.
Yeah, and also understand that it's not illogical. It is logical. It's what they're doing is, in this example I'm giving.
The parameters
Yeah.
Of the equation are different, but it's still a logical equation.
Yes, and so trying to force behavioural change for your elegant new solution may not always be the right way to go. You might need to think about what are the dynamics here that are really at play, take the time to understand that, which is almost like a sort of sociology project in itself, and that may get you to better solutions in the end. So there's a couple of things that I think about. I'm sure that if we wanted to, I could go on for the rest of the day, but I think these are two things which are interesting.